In our strategy, we use a five-phase cycle framework. We do not predict headlines. We track signals and sequence risk. Rates are spiking again, gold and silver are ripping, and the story is suddenly, sell America. This matters because rate shocks change positioning fast. They can look structural before they actually are, so we need to separate mechanics from narrative. We are reviewing a Rebel Capitalist episode on rising global rates. It is technical and worth watching in full. Our role is translating the signal into our strategy. The claim is not capital flight, it is a mechanical unwind, similar to what we saw earlier this year. This is happening because inflation surprised expectations. When that happens, bond markets reprice quickly, and crowded trades get forced to unwind. The long end moved first, the short end barely moved. That usually points to positioning, not panic. Japan matters because rates were pinned for years. When that anchor moves, global rates move with it. That is transmission, not politics. Debt did not suddenly explode this week. Japan debt ratios are lower than years ago, so debt is not the trigger here. Rates tend to follow nominal growth over time. Japan nominal growth surprised higher. Markets had to adjust quickly. Equities react first with volatility, but without labor damage, dips often fade. That is late phase 1 behavior. Gold is not moving because of CPI. It is moving because counterparty risk rose. That is when gold usually works. Silver follows gold in these moments. It is higher beta and more volatile. So the move looks extreme. This is not a confirmed regime break. It is not forced liquidation yet. It is a stress test. In our strategy, this reinforces phase 1, melt up with cracks underneath, not phase 2 yet. Short-term reversals are common after shocks. Medium-term risk continues to build. Labor decides the turn. Levered rate trades get hit first. Narrative-driven positioning follows, not long-term capital yet. We respect rate volatility more. We watch Japan closely. We tighten sequencing discipline. Labor remains the main trigger. Cash stays optionality. 1 week moves do not flip phases. Quick disclaimer, this is educational macro analysis only, not financial advice. Does the 10-year retrace? Does labor weaken beyond noise? Does funding stress spread? We do not need to be early, we just cannot afford to be late.